In forex trading, a scalping means making many small trades over a very short time period to take advantage of small price fluctuation happening in the market. Forex scalpers buy and sell a currency pair during reversal of the price and closes the position when it becomes profitable. Scalpers used to repeat the same process throughout the day to gain frequent returns by taking advantage of price fluctuations. Since only small profit can be made from each trade, forex scalpers usually aim for highly liquid currency pairs to scalp between 5 to 10 pips from each position, aiming to make a more significant profit by the end of the day. Although short-term trades aim to profit from price movement of just a few pips, but when leverage and spreads are high, they can also result in significant losses if not done correctly. Successful scalping traders require super quick interaction with the price movement, as they typically enter and exit trades within a few seconds or minutes. This method relies primarily on technical analysis and chart of a shorter time frame. The ideal time frame for scalping is from 1 minute to 15 minutes, which is widely used by scalpers to generate quick profit. These charts are used to analyze the market, build forecasts, and determine which trading setup is optimal. Another benefit of this time frame is that it helps traders to focus on narrow and specific parts of the chart to make smaller trades.